Welcome, clients and friends, from our downtown Ventura office and our studio here. We want to extend a warm greeting and welcome to all of you for taking time out of your busy schedules to participate in the first town hall of 2026. Here we are already January, and as you can see from our theme, it's just our beginning of the year town hall, and we're going to share some thoughts and ideas. So let's get right into it. We're going to look at our agenda here first. We will examine, even though it's only been literally less than 2 weeks of trading, we're going to look at the market returns so far. I think there's a message in these returns for everybody to learn from. I'll share what that is. We'll share some economic updates and charts and give some thought on what we think is in store for the economy in the U.S. in 2026. We're going to go into some financial planning reminders, things that we think should be top of mind for you. Some of them are pretty obvious, a couple of them not so. And we want to always be on the forefront of giving you things that are thoughtful, things that you should be thinking about outside of just investing. So we'll do that. And then we're going to update you on some of the exciting changes here at Integrity Wealth Advisors. We're super jazzed about it. We think you will be too if you're not already. And then, of course, we always are going to enjoy Q&A here as well. So if you have a question, just type it in the chat room there or raise your hand. And Gavin, our administrator here of all affairs, audio and visual, will let me know. He'll raise his hand and point a finger at me, and we'll make sure that you are heard. And be happy to answer any questions anybody has. All right, so let's get into what this market is doing so far this year. It is pretty interesting what's going on in the market. All right, so let's that for some reason. There we go. Trying to click this. There we go. So S&P 500 total return so far this year is up an astounding 1.26%, and that's on the backs of 2 negative days in a row. Importantly, there's a rule in January called the first 5 days of January. And if the first 5 days of January are up, which they were, it almost always results in a positive year for stocks. And so here we are, 2 weeks into the new year, and the S&P 500 is up 1.26%. Now, interestingly enough, though, outside the U.S., take a look at this number. Outside the U.S., just like last year, that saw international stocks really beat the S&P 500 pretty significantly. It's doing it even more so this year. It's more than a 2-to-1, almost a 3-to-1 advantage for international stocks, up 3.47% so far in the year. But look at the real winner, something we've been talking about now for a few months in our town halls, that small company stocks, as represented by the Russell 2000. This is a number that I've not seen in a long time. Again, it's a 6% return in 2 weeks. We know that's not sustainable. We know there will be volatility, but I think there's a message here, and we're going to expand on that in the next slide a little bit. But first, we don't want to forget bonds. So far, the underlying index, as represented by the Vanguard Bond Fund, BND, is up just 0.30. But let's put that into perspective. That's just 2 weeks. Again, the Fed's going to be cutting, as we're going to be talking about, and that is generally very, very healthy environment for bonds. But let's take a look at another slide here that I think is very interesting, and that's this. This market is broadening. Now, I'm just showing you 3 different indexes. The purple line down there at the very bottom is the S&P 500. Now, this slide is not completely up to date. We're showing a 1.74% return there. That was a couple of days ago. But nonetheless, the story is the same story. The S&P up 1.74. Take a look at that middle slide, the blue line there. That is something called the Invesco S&P 500 equal weight fund. So first of all, let's understand the S&P 500 is 500 stocks, largest, most successful companies in the United States. But if you're a bigger stock, if you're a bigger company, say like Google or Microsoft, you're going to make a bigger percentage of the S&P 500 because it's a cap weighted market capitalization. So the number of shares outstanding times the share price, and there's your market cap. So for example, Google, $4 trillion market cap. If they go up or down in a day, they're going to have more of an impact on the return of the S&P 500 than, say, Bank of America, which is about 250 billion in market cap. And so, again, there's nothing wrong with that. That's the way indexes work. They're all market weighted. But when you look at something called an equal weighted index, it gives you a more accurate understanding of the health of the market. And the RSP, the equal weight S&P 500, is almost doubling the returns of the S&P 500. What does that mean? Well, as our slide suggests, the market is broadening out. We've been talking about, again, for the last several months, the other 493. They're going to be the major beneficiaries of an expanding economy and of course, with the Fed cutting rates. But what is most impressive is the small cap index, up 6.11% so far year to date. And that is astounding. I've not seen this in years. You have to go back to 2020, the COVID year, to see this kind of outperformance on the part of the S&P, of the Russell 2000, the small cap index. Literally the last 5 years, it has underperformed horribly versus the S&P 500. And we're seeing some significant outperformance so far. We're gonna comment on to the reasons why that is, but we thought that this slide, in a lot of ways, really tells it all as to what's going on in the market. I'll even say this: the last 2 days, the S&P has been down, and of course, year to date now it's up 1.26, which is still great. The last 2 days, the Russell 2000 has been up. Very interesting. So when you see that kind of divergence, particularly in down markets, I think it's confirmation that you're seeing a rotation by big institutions in money, not so much completely away from the big stocks. Certainly that won't happen. But they are now addressing this part of the market that is underperformed and, quite frankly, have very attractive valuations. And so we think this is a theme that's going to carry on through the entirety of this year, and we're going to get into some reasons why. So let's look at some economic and market data. Unemployment, 4.4%. It had been rising every month for the last several months, and then this last month, December, it came back down. Interestingly, there is now 0.8 jobs available for every one person looking. It's a very healthy equilibrium. Remember a few years ago, there were 2 jobs available for every one person that was looking for a job. Employees could not be productive at work and still keep their jobs. Employers were fearful to lose their employees, so they let them do basically what they wanted to do at work. That's not the case anymore. We have now a very healthy equilibrium between employer and employee positives. And what does that mean? Ultimately, it means better, more productive employees. It means a lower unemployment rate. So we were very happy to see this rate come in. It's very positive for the economy because, again, if people have their job and they're confident that they're going to keep their job, they're going to spend whatever excess money that they have in their wallets or purses at the end of the month. And that's good for an economy such as ours, which is based upon consumption. We're a 70% consumption economy. So very, very good news there. Retail sales, not surprisingly, are at all-time highs, in spite of the fact that so many people are negative on the economy. There's something called the Michigan Consumer Sentiment Index. They send out thousands of surveys every month, and people answer them. Are they going to buy a house or car? Do they plan on going on vacation? How do they feel about their job? How do they feel about the future, etc.? And it's at an all-time low right now. And yet, retail sales are at all-time highs. So the U.S. consumer is doing exactly what the U.S. consumer always does if they're confident that they have a job. They may be negative about everything. They may complain about everything. But boy, oh boy, are they going to continue to shop on Amazon. And we're seeing that in the actual physical data. While the holiday sales numbers are not out yet, estimates are that they're going to be very, very strong. So that should continue to do well for the economy. Gross domestic product. This is, again, amazing. At the beginning of this year, the average economist projected a 1.6 to 2% growth in our gross domestic product. We're running at 4% right now. And if you go to GDP Now, gdpnow.org, I believe it is, it's the Atlanta Fed. That's the Fed, Federal Reserve Bank, that everybody looks at in terms of what's going on with GDP. For the last quarter of last year, they've got it running at over 5%. I'm starting to hear, good economists talk about a 4 to 6% GDP number this year. If that happens, with the Fed lowering rates, as we're going to talk about right now, you're going to have a market that's going to do very, very well. You're going to have companies that are going to be very, very profitable. And it could very well be that's the reason you're seeing that small cap index up so much so far in the early part of January. As I mentioned, the Fed is going to be lowering rates. You've also had recent CPI readings coming down. We're going to share more information next month on this. There's actually some very good data that suggests that inflation should fall all the way down to 2% by the end of the year, or even potentially lower. And again, we recognize this is the way the government calculates inflation. We don't want to offend anybody. I know when I go out to eat, it seems like prices just continue to go up. But the market only cares about the way the government calculates the CPI number, and it's coming down. And as a result, the Fed feels comfortable lowering rates, as they've done now 3 months in a row. September, October, and December. They've lowered rates 3 meetings in a row. So again, we expect this month, our favorite economists are suggesting anywhere from 2 to 4 in that range. And that, again, would be very accommodative, be very good for stocks, very good for bonds. Anything that pays a dividend will thrive in that particular environment. Record stimulus is coming. This is something we're going to do a deeper dive on next month as well. But right now, there's about $12 trillion in domestic and foreign investment that has been announced. Much of this is already broken ground. You think about it, you build a building, what do you need? You need a whole lot of construction workers. You need a whole lot of supplies. The ripple effect is remarkable. Again, smaller companies will benefit from that kind of economic activity a lot more than larger companies. Again, that's probably the reason why you're seeing that small cap index do so well so far this year. This will result in record corporate profits. Again, we had most estimates for corporate profits at the beginning of last year, 2025, were in the 6 to 8% growth rate range. The numbers aren't totally in yet, but it's looking like a double-digit 12 to 14% corporate profit surge, significantly higher than the average analyst estimate. And right now, the average economist is saying that corporate profit growth should come in around 14% in 2026. So it's very difficult to imagine under any of these environments here, with a better regulatory environment as well, that you're going to have any kind of slowdown of the economy. And there's one more nice little tidbit that affects a lot of you that are listening out there. It doesn't benefit some of you that are listening out there as well. But there's going to be a substantial increase in tax refunds in 2026. Why is that? The tax bill that was passed back in July of last year allowed for no tax on tips over time. It also included extra $6,000 deduction for anybody 65 years of age or older. So a married couple, they're going to get $6,000 each. That's $12,000 on top of their already $32,000 or so standard deductions. So you're looking at, $45,000 before any of their income is taxed. Pretty remarkable. Oxford Economics estimates that this is going to total about $90 billion in additional refunds, again, over and above the normal. And the average filer, if you break that down, will receive anywhere from several hundred to $1,000 more in May, June, July of this year. You don't think that's going to help the economy? It certainly suggests so. I don't think most of these folks are going to invest this money or put it in the savings bank. I think they're going to go out and spend it, as we're trained to do. That's what we do here in America. So we think those are very important points, and we're very, very happy to share them with you. Now, how does this relate to IWA's 2026 investment strategy? Let's take a look at that here. So first of all, as we've said many times over the last several months, the other 493 stocks in the S&P 500, this is their day in the sun, and we're seeing it. Remember that RSP, that equal weight, where all 500 have a 0.02 weighting, all right? And you times that by 500, it's 100%. Instead of NVIDIA at 7 or Google at 7 or Microsoft at 6 or Apple at 7. You've got basically those 7 stocks equate to about 25 or 30% of the S&P 500. That's fine. There's nothing wrong with that. But the results and the health of the S&P can be skewed. Remember, back in 23 and 24, the S&P was up 21 and 24% respectively. But if you took out the Mag 7, if you eliminated those from the S&P 500, the S&P was up 0. I would argue that's not a healthy environment for stocks. Well, we are getting into a much more healthy environment. Last year, still a domination by the Mag 7, but not as much. And again, so far this year is represented by that equal weight being up more than double the S&P 500. That's a good sign that the market is broadening out, and that's very, very healthy for investment returns. Smaller companies are poised to do well in this particular environment, as we've talked about. Bonds should have another really good total return year. I don't think they'll be as good as last year. As the Fed continues to lower rates, the CD rates will come down. There are, by some estimates, $5 to $7 trillion in CDs alone. There's another 3 or 4 trillion in money market funds, and there's many, many trillions in checking and savings accounts. Imagine what's going to happen potentially to some of that money. You think it might be chasing some of these bond funds? Yeah, this money might not go into the stock market because it's coming from something safe. So they want to find something commensurately that's safe. That would be a bond fund for the most part. And this should result in another really, really good year for bonds. I'll tell you something, and this is not convention. If you tune in to financial media, almost everyone says that expect a lot of volatility this year. Of course, they say that every year. So it's almost a CYA statement to say that. Now, look, we realize that in a typical year, there's usually a 10% downturn. There's many, 3, 4, and 5% downturns. But there was a year back in 1995, long time ago, 30 years ago, where the market almost acted like a CD. And it's interesting because it was that year where the Fed was lowering rates in an otherwise good economy. Wow, that sounds familiar. That sounds like right now. The Fed is lowering rates in an otherwise good economy. And quite frankly, an economy that is expanding. It's building steam. We met with our CIO, our CIO firm that we use, Chief Investment Officer firm, their mindset is that we're in a recovery mode in the economy. So far be it from being like, past the expansion and we're in this mature economy that is getting ready to roll over and go into a recessionary environment, a contractionary environment. We are in an economy that is just getting started. And you think about all the things we talked about, the Fed lowering, lower regulation, $12 trillion in potential spending over the next several years, the tax refunds, the tax bill, all of these things. We think this could be a repeat of 1995. Let's take a look at that. This may be a little hard to see, and really what this chart is not just 95, which is right here on the lower left. You can see 1995 if you squint really good. But it also shows all the way 96, 97, all the way through 99. Now, the orange line is the S&P 500. The purple line is the Fed funds rate. So as you can see, the Fed was lowering in 1995. And look what the market did. I mean, almost no volatility. Sadly, I remember that year almost like it was yesterday, even though it was 30 years ago. I don't know the data, but there were no 10% downturns, and there was, I think, hardly even a 4 or 5% downturn. Most of the downturns were 1 to 3%. That's lower than normal volatility for an average market year, and that's why you see almost a straight up line in 1995. And of course, the economy was expanding during this period of time. Very interesting. Now, as you go beyond that, it became more normal in its volatility. The Fed did the major lowering here, paused, and then even raised a little bit, paused again, and then lowered. And it's very interesting. You can see every time there was a lowering, the market went up. When there was a pause, the market went up. When there was a hike, take a look at this, the market went down. And then when there was a pause, the market went back up. And then when they lowered it again in the summer, fall of 1998, yes, I remember that, the market went back up again, and so forth and so on. So am I predicting a repeat of 1995 through 1999? I'm going to say it's very possible. I'm focused on 2026. And when I look at all of the economic activity, the favorable tax laws and rules, the refunds that everybody's going to be getting, the lower regulatory environment, and all of the investment that's going on in America, please forget your politics. It's very, very important to forget your politics. We have forgotten our politics. We are just looking at the facts. Our job as messengers, clinicians, is to look at the facts, decipher them, and say, hey, what investments should do well in this environment? And it is very, very clear to us what should do well, and we want to communicate that to you guys. All right? So, good stuff. So the lesson there would be any dips, you want to be a buyer of those dips. Or if not a buyer, just be patient. It won't be a long dip in all likelihood. All right. Maintain discipline and rebalance as the year goes along. That's our investment strategy. As we said, we're gonna rebalance every few months. If for some reason we do get some out of the right field dip, as you know, we'll be buyers of that dip. That's been our philosophy going on. Of course, be alert for opportunities and pullbacks. Now, why do we put this in here? We just got finished saying that this could be like 1995. Well, here's a caveat. Okay. This is a midterm election year. Midterm election years are normally very volatile years. And we're going to share a slide in that regard right now. So I hope you can see this. Again, put your glasses on or squint like I am. In fact, I'm going to put my glasses on and I'm going to look at this. Oh, that's so much better. So what this is a chart, midterm election year drawdowns. This is every midterm from last one back in 2022 all the way back to 1950. And so every single midterm, what we're looking at here in the orange down line, is the max drawdown during that year up to the midterm. Okay, so we know the midterm, that first Tuesday in November. You can see back in 1950, there was a 12% downturn. In 54 and 58, it was pretty identical, a little over 4. What are you noticing here, though? What do you gather from this? Well, one of the things I gather is that every single midterm year, there's some pretty brutal downturn potential. Now, our thinking is it'll likely be more like 1954, 1958, maybe 1994 or 2006 because of all of the positive tailwinds that we've already talked about. I mean, it's, again, don't fight the Fed. You've heard that phrase. Don't fight them. That still doesn't mean that there couldn't be a more brutal downturn in the market. Our thought process, though, is even if you get something like 1962 where the market was down 26%, or 1974 where the market was down 35%, God forbid that happens again, you don't want to panic. You want to trust us to do the right thing for you, and that's rebalance, sell some bonds that'll be going up during those down times, and move that money over into your stock or equity exposure and buy those on the cheap. Because look at what happens 12 months after a midterm. So you have the first Tuesday in November and everybody goes to the polls, and then the next day that clock starts 12 months forward. Again, let's look back at 1950, down 12%, but look at 12 months later after the market bottomed, and that 12% bottom was in. 12 months later, you had a 24% return. And you can see the returns across the board can be pretty astounding. So we share this to temper our own optimism and to temper your own, as well as to, just share a little bit of history. We think this is really important from our standpoint to do, to let you know that we're keeping our eyes open to this. But history is pretty cool. When you see trends like this, we'll weather whatever downturn there is between now and the time that the market bottoms this year, because we know when those midterm elections are over, everything gets back to normal, and the market moves right back up again. And again, as I said, there's too many other really good tailwinds to this economy. Okay? All right, we hope you enjoyed that part of the presentation. Now we're going to talk about some financial planning thoughts for 2026. First of all, understand your tax bracket. We're going to share that with you right now, and you can kind of, again, put your glasses back on as I will. These are the 2026 tax tables. I know this is kind of mundane, but, when was the last time you looked at the tax table? This is particularly important if, for example, let's say you're going to have some time off this year. You're not going to make the kind of money that you did. Do you know where your bracket is? I mean, you think about it, if you look here, you're a married filing joint. So you go down there, the bottom left side of the tax table there. I mean, do you realize you can make up to $211,000 and still be in the 22% tax bracket? Bear in mind, that's after you get that deduction for your AGI, for your standard deduction. So, it may be that maybe you got a stock you wanted to sell that had big gains. All right, we're going to share another slide on that in a moment. Just knowing your tax bracket and timing when you take money out of taxable things is something we'd like to help you with. We have a special piece of software here that we can upload your tax return, and it'll do an AI analysis and give us some suggestions. And we can actually plug in, well, what if you take some money out of your IRA and maybe convert it to a Roth? And we're going to talk about that here in a moment. Maybe that keeps you in a low tax bracket. All right. So those are things that we can do for you. Here's something else that I think is a good reminder that most people don't know. You think about what is the long-term capital gains rate on selling a stock or a house? Well, it's 20%. But did you know that it could be zero? Have you thought about that? We'll take a look at the tax table here. Literally on a, we'll just look at the married filing a joint return, up to 98,000 of long-term capital gains is taxed at zero. If you're single, half of that. So maybe you are retiring. Maybe you are stressed out about not taking Social Security for a couple of years, so you don't have that income. Maybe you can put off your pension if you are qualify for one for a year or two, and live off some savings, and maybe sell some of that Nvidia stock or Apple stock or highly appreciated stock and create tax-free income. It's a good idea. There's also a 15% bracket. Take a look at that. All the way up to $613,000 in total income. So again, we think about long-term capital gains as 20%, and it's locked in. And normally it is if you're selling a house. You're going to sell your house for $1 million, and you're going to have a $500,000 gain, and then you've got other income, so you're over that $613,000. But every situation and circumstance is different, and then that's what we're here for. We're here to help you plan for these life events. All right, give to your favorite charity intelligently. What do we mean by that? Most people just give to their charity blindly. And that's good. You should give to your charity. You should help those causes. But hey, wouldn't you like to put some of that back in your pocket? I think you would. I know I would. So what are we talking about here? Well, typically, for most tax filers, not all, but most, you don't itemize. Where do you write off charitable contributions? You write it off on Schedule A, your itemized form. So what do you do typically? Well, you bring your CPA all of your, receipts that you made contributions for and letters of contribution from the charities, etc., and you put it in a file and you're real happy. You give it to your CPA and he or she just looks at it and puts it at the bottom of the pile. Why does he or she do that? Because they know they don't have to worry about inputting it, because you're going to get the standard deduction. That's typically much bigger than if you itemize and have all of your interest and other itemized deductions on there. It doesn't add up to an amount greater than the standard deduction. So you're going to get the standard deduction and you're going to walk away thinking, oh, I wrote all that off. And you didn't write any of it off. So there's a better way to do this. First of all, a little twist in the new tax law does allow, I can't remember the number off the top of my head, but it's not much. I think it's $1,000 or $2,000 separate line item. So that's good. But again, many people give $5,000, $6,000, $7,000, $10,000 and they're not able to write it off. But if you're 70 and a half or older, even though you may not have to take an RMD, required minimum distribution from your IRA, you can take a distribution in the amount of the money that you typically give away. You just come into the office, talk to Cindy, talk to Sharon. They'll have you fill out the forms. The rules are you can't receive the money. It must directly be sent to the charity. So for those of you that are required to do an RMD and you don't need your RMD, and that's many of you, why not do your charitable contributions through your RMD? So let's do a game here. Let's say your RMD is $15,000 and you take it. You got to pay taxes on $15,000. But earlier in the year, you would normally give, say, $5,000 or $6,000 to charity. Well, instead of giving it directly to the charitable organization from your pocket, from your bank to them, which you get no deduction on, because again, you don't itemize. Most of you don't. You come into Sharon or Cindy, fill out a form and say, hey, Boys and Girls Club, XYZ Church, whatever the organization is, and you can do as many of them as you want. Whatever that adds up to, let's say it's $6,000 and your RMD is $15,000, you're only going to pay taxes on $9,000. So you're getting 100% deduction right there. There are many other ways that we'll talk about throughout the year to give intelligently. That's just one of them. And we want to remind you of that. Okay, let's go on. This is huge. This is sad. Be careful who you make, who you name in your living trust as your successor trustee. What do I mean? Well, typically, maybe you have your mom and dad passes away and mom is left. And mom has 4 children. Mom doesn't want to disappoint any of them. So she makes all of them co-trustees. Do you think that's wise? I think most of you are shaking your heads no. Some of you might be doing that though, because it's an emotional thing. Let's draw this down. A real life situation. We've got a scenario where a mom died. She had been married a couple of times and children from each marriage, and made children from each marriage co-trustees. One of the children from one of the marriages can't stand the other child, and yet they're co-trustees. This situation has been going on for months and months and months and months. Should have been resolved 4 or 5 months ago, and it's still going on. And all it's doing is eating up the trust in terms of lawyer fees. So how could this have been avoided? Well, number one, if you're going to make a child trustee, just make one of them. Just have a family meeting. All right, we need one person here with the experience and try to get a consensus. If you can't get a consensus, hire a professional trustee. We have good professional trustees that we can refer you to. We would love to do that. And it would eliminate, in this case, it would have eliminated all of the problems and everybody would have got their share a long time ago. I mean, that's one of the reasons you get a living trust. It's because it avoids probate. It's private and it's fast. Not in this case, because the mother, beautiful woman as she is, and I knew her, and thought she was doing the right thing by making everybody happy. Sometimes that works. Sometimes it doesn't. It hasn't in this particular case. So, sometimes a real life example, hits you right in the face. And it's our job as your friend, your advisor, your fiduciary to, bring these things as reminders to you. So make sure you have the right person or people or a professional trustee as the person handling your affairs in an unemotional, logical, speedy manner when you go to the next world. All right, let's go to the next slide here. The power of the Roth IRA. You're familiar with a Roth IRA, right? Roth attributes, non-deductible contributions, but tax-deferred growth. If you make it to 59.5 and you take money out, all of the earnings are tax exempt. And even before 59.5, you're allowed to go in and pull out contributions tax-free. Why? Because they were never deductible like a normal, regular, traditional IRA is. And there's no RMD requirements. That's another huge positive. No requirements to pull money out at 72. You can let that baby grow all the way to the end, and your children can inherit these Roth assets tax-free. Now, RMDs do apply to non-spouse beneficiaries. They do force them to take the money out over a period not to exceed 10 years. The government doesn't want these things to grow and grow and grow and become unbelievable mountains of money over time that the government never benefits from, even though they're not going to benefit from any taxation, even on the children inheriting this. The children will spend the money. That'll get into the economy and that'll create other economic growth. So you think about it for a moment. If you could, right now, think about your IRA. Think about how much money you have in your regular IRA. If you could snap your fingers and change it to a Roth Every single one of us would do that, myself included. In fact, it makes me sick looking at my IRA, thinking that could be a Roth. Now, why do I say that? And you'll say, well, wait a minute, Steve. Hold on, slow down. Didn't we get an income tax deduction? Sure. Where is it? Where do you have it? Did you invest it somewhere? Is it growing somewhere? That tax savings, or is it a place you can go access it? Probably not. It isn't in my case. I spent it. You probably did too. Okay, so we might spend a little less money by having a Roth, but I think down the road, if you look at a gigantic IRA, boy, do you wish you see the name Roth up there on that statement. So there are some things that you can do. If you miss the boat on this, you don't have a Roth, consider a Roth conversion. Again, we go back to those tax tables. You might say, okay, you know what? I'm in that 22% bracket, but I'm far away from reaching the end of that bracket. Maybe I convert some of that. The government allows you to do that. Convert some of that, some of your IRA. You're going to pay taxes on it right now, of course. But down the road, you're going to have all that growth, and you're going to be able to pull money out on a tax-exempt basis. It may work for some, it may not work for others. A lot of it has to do with, how old we are and how much time we have left, and what theoretically, what can we grow this at. But again, we have software for this. So we would urge you to, make an appointment. Call me, Lainey, or Doug, and say, hey, I want to sit down and talk about this. Would it work for me? We can illustrate it for you visually. And we think that's a really, really good idea. Okay? All right. So we want to update you on some exciting things here at IWA. Just quickly, as you know, we're moving our client assets from LPL to Schwab. And there's been some confusion about this. So I want to kind of eliminate that confusion. So first of all, you are clients of IWA. Integrity Wealth Advisors is your financial firm, and you are our client. Just like any firm that works with vendors, we work with vendors. LPL is a vendor. That's all they are. They're a vendor. Schwab is a vendor. The guy that comes out and services our copy machine is a vendor. All right? And we get to decide who our vendors are. Now, obviously, it's a little more complex when it comes to, hey, we want to move money from LPL to Schwab. You got to fill out new account forms, and we know that's onerous, and we apologize for that. We believe that all of the pluses are going to come in. I mean, Schwab is a respected name, superior customer service, a much easier log-on experience. Our staff is going to enjoy a much better level of service as well, and by simplifying, we can spend more time doing a better job for you. We're dealing with two different vendors, and I will tell you that LPL is a pain in the neck. Okay, they are in many respects. We've had a relationship with Schwab for several years, and we never get any complaints from those clients. We get regular complaints from LPL. So again, we think ultimately, even though it's a little painful right now, it will, in the long run, it'll be very beneficial. Not just the superior customer service, but for those of you that really like to research stocks and to look at charts and to have real-time live information. I mean, Schwab is it. I mean, I really appreciated those features as I've gotten to know Schwab better. You couldn't do most of that on LPL. That would just be a dream. So we think this is going to be a really, really good move. Also, we're going to be announcing pretty soon, some of you have seen this and we're just kind of getting used to it, new software, new reporting software. So like when you come in and you want to know how your accounts are doing versus the market and all the individual positions, this is a company called Orion, much bolder, more flexible and versatile software that you will enjoy. You're going to have one consolidated online experience. Many of you have accounts only at Schwab now, but many of you have accounts like at Schwab, maybe some annuities like Nationwide and Jackson National. Typically you have to go to each site to get information. You're going to be able to log on here and see performance information, everything on one page. As a matter of fact, you'll be able to tie in other accounts that you may have, bank accounts, credit cards, other outside investment accounts. Shame on you. You'll be able to get all of that in on an app that you'll be able to log into. This is going to be really, really good as we roll this out. And as I said, you'll be able to view all of your investment products, accounts at various institutions. You'll also be able to view your financial plan that you have at Wright Capital. Now, we know you log in there now, but think about it. Log in there, log into Schwab, log into Jackson or Nationwide. You'll just log into this one place, and everything will be accessible from there. It's kind of like this will be your quarterback in a sense. Everything emanates from that position. All right, you'll be able to view recommendations also from past meetings here at IWA. So we're really taking advantage of technology. And speaking of technology, take a look at our new website. We've gotten some good feedback, and we thank you for that. Fresh and updated content, interactive videos and apps, and we're going to be adding to that like crazy. New client portals to Schwab and our wonderful clients who have said nice things about us. If you have a really positive story, let us know. If you have a negative story, let me know. I really want to know about a negative story. We do take all of that very, very seriously. And of course, there'll also be links to all of our professional partners, the lawyers and CPAs, professional trustees that we refer you to. You're going to click on their name and go right to their website. Make ease of contact and ease of making appointments with them, we think is very, very important. So this is really going to be a great, great, great site. And of course, our wonderful team, we just wanted to get their pictures up here. They've done a phenomenal job through this transition to Schwab. They've been under a lot of pressure. They've been very, very, very busy. And we know, and we're grateful for all of the great comments that we've heard from you folks supporting the hard work that they do. And we thank you for that. And that'll be it. If you want to schedule a 15-minute consultation on anything that we talked about, this is your portal to do that. But I'll shut up now and see if there's any questions, Gavin.
There are no questions.
All right, awesome. Well, on behalf of all of us here in Ventura, as well as our Ojai office, we thank you for taking the time out of your busy schedules to view this. Please feel free to contact us at any time, and we will look forward to seeing you next month in our February Town Hall. Have a fantastic evening, everybody.